In this video, we're going to build a complete trading process step by step. We will connect market structure, liquidity, flip zones, higher time frame analysis, premium and discount, and advanced entry models into one framework that you can use to analyze the market, identify opportunities, and execute trades with confidence. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let us begin by building this entire process step by step, starting with the one element that defines direction, provides context, and gives every other rule its meaning: market structure. Without a clear understanding of structure, concepts like liquidity, flip zones, and trade execution become far more difficult to apply consistently. Imagine the market is in an uptrend, with price consistently forming higher highs and higher lows. Now, pay close attention. Price pushes higher and breaks above the previous swing high. This movement represents a clear break of structure and signals strong buying pressure in the market. So, what do we do next? Instead of reacting immediately, we look back on the chart and identify where that impulsive move started. That origin point defines our demand zone. This is the area where buyers stepped in with enough strength to break market structure. But here is the most important part. We do not chase price. Instead, we remain patient and wait for price to return to that zone. When price comes back, we observe how it reacts. If we see the right type of confirmation, that is our signal to enter the trade. Once structure is defined, the next thing we need to understand is when control changes and how to recognize it on the chart. This is where flip zones come into play. A flip zone occurs when supply turns into demand, or when demand turns into supply. These zones are especially powerful because they often lead to high-probability trade setups. Let us move to the charts to see how this works. Imagine the market is in a downtrend, with supply clearly in control. Price breaks structure to the downside and forms a new supply zone. After that, price pulls back into this zone and attempts to continue lower, but it fails to break the previous low. At that moment, demand starts to step in. Price changes direction, breaks structure to the upside, and continues moving higher. This is a textbook example of a flip zone. The key takeaway is to mark this area. If price returns to the zone and shows confirmation, it becomes a strong level to look for long trades. Patience matters here. Wait for a clear failure of supply and visible strength from demand. Before a real move can fully unfold, the market often needs to remove liquidity and clear out weaker participants. This is where sweep zones come into play. Sweep zones help us identify where large players are actively moving the market. Let us simplify the process. Price is trending higher, printing higher highs and higher lows. Then a pullback occurs and equal lows are formed. These levels are common areas where retail traders place their stop losses. Price briefly moves below those lows, triggering the stops and releasing a wave of sell orders into the market. But here is the key point. Price does not continue lower. Instead, it quickly reverses direction. The reason is that institutions are stepping in and using that liquidity to build large buy positions. Once price rallies upward and breaks the previous high, we have confirmation of strong demand. At that point, we mark the zone and wait for price to come back. When price reacts there, that becomes our entry signal. Simple in concept, but extremely powerful in execution. Even after liquidity is taken, not every setup should be traded. We still need to understand whether that move aligns with the broader market context. This is where higher time frame alignment becomes critical. When multiple time frames point in the same direction, your trades naturally carry a higher probability of success. Begin your analysis on a lower time frame, such as the M5 chart. At first glance, price may appear to offer a clean sell setup, with clear lower highs and lower lows. However, do not rush into the trade. Take a step back and zoom out to the M15 chart. You may notice that price has just tapped into a strong M15 demand zone that has not yet been broken. At that point, the structure on M5 can suddenly begin to flip bullish. The lesson here is critical. Always respect the higher time frame. When lower and higher time frame setups align, you are no longer trading a single pattern. You are trading in harmony with the broader flow of capital and time behind the move. With that higher time frame context in place, we now have all the key building blocks needed to create a complete trading framework. The next step is turning these concepts into a concrete execution model. This high-probability setup combines higher time frame flip patterns with optimized entry tools such as breaker blocks or mitigation blocks, forming a precise trading model capable of producing A-plus trades on any chart and pair. In a bullish scenario, the pattern appears when price flips the latest demand area right after tapping into a higher time frame area of interest. Price then returns to the newly created flit zone, which now operates as a supply area. From there, it often reverses with strength, pushing against the current trend and signaling a potential change in direction. In a bearish scenario, the same setup forms when price flips the most recent supply zone immediately after being rejected from a higher time frame area of interest. Price then retraces back into the flip zone, indicating a possible shift from bullish momentum to growing bearish pressure. It is not as simple as it seems. Several conditions must be satisfied before the setup becomes valid. So, let us make everything clear with a chart example. In a bullish market profile, imagine price moving from a higher time frame demand. That means demand zones remain in control. The first step is to identify market direction by marking the break of structure and the demand zones linked to each impulse leg. Every time price breaks a previous high, it creates an unmitigated demand zone at the origin of that move. After marking market structure manually and identifying each break of structure, you can clearly see that the price is in an uptrend. It has already formed several upside breaks, and those moves have created the demand zones tied to each impulse. What we want to see next is price tapping into a higher time frame point of interest, such as an unmitigated supply zone or an unfilled fair value gap, and showing rejection. Once that rejection occurs, price shifts direction and pulls back until it reaches the most recent demand zone on the current time frame. It then tests that area, reacts slightly to the upside, and immediately breaks through it with a strong bearish displacement move. This confirms that supply is taking back control of the market and signals an upcoming shift in direction. At this point, direction is clear, but there is still one important question left. Knowing where price wants to go is only part of the equation. We also need to know whether price is trading in a favorable location for the setup we are planning. This is where the concepts of discount and premium become extremely valuable within the ICT framework. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone. These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. With that foundation in place, let us return to the reversal setup we were building earlier. One of the reasons premium and discount matter is that they help us determine whether a flip zone is forming in a favorable location. Now we have a flip zone positioned in the premium area, which gives us a clean selling opportunity if price retraces into it. This might seem a bit complex at first, but do not rush the process. Stay calm. We are going to break everything down into clear, actionable steps with all the criteria and rules required before this setup becomes valid. But before going deeper into the details, let us quickly revisit what flip zones are and how to identify them correctly. A flip is a small reaction to a key demand or supply zone, followed by an immediate breakout. It's a strong reversal pattern that signals a coming shift in market sentiment and direction. Flip entries are one of the most effective ways to catch a setup early while the market accelerates aggressively in either direction. In a bearish example, the psychology is straightforward. Price is in an uptrend, demand zones are in control, and we naturally expect higher prices. But suddenly, the narrative changes. The latest demand zone fails to generate enough bullish strength to break new highs. It weakens, loses influence, and eventually gets violated. This shows that supply is back in control, and from this point forward, we should shift our focus to selling opportunities. The last up-close candle, or the cluster of up-close candles at the origin of the bearish flip move, becomes the flip zone. In simple terms, those bullish candles inside the reaction phase mark a key area where we should look for short opportunities if price pulls back. In the same way, a bullish flip zone forms when price shows a small reaction to the latest supply and then breaks above it. In that scenario, the last down close candle or the group of down close candles at the origin of the bullish flip leg becomes the flip zone. Now you might wonder what the difference is between a change of character and a flip. Flips and choke patterns are both reversal signals, but here's the key point. Every flip is a choke, but not every choke is a flip. Price tends to reverse much faster when a flip forms, which means flips offer a stronger edge than standard change of character structures. They are also more mechanical and rule-based, giving you a clear entry point while indicating a potential shift in market direction. But keep in mind that not every flip is valid or tradable. For a flip to be valid, price must first mitigate and reject a higher time frame key zone. This rejection shifts sentiment and prepares the market for a true directional flip. If price does not mitigate a supply or demand zone and instead forms a flip pattern in the middle of nowhere, it is likely an inducement, a liquidity grab, or just a normal retracement, not a genuine shift in direction. Patterns like that should not be treated as valid flips. Flip patterns also become more reliable when price leaves a noticeable inefficiency during the flip, because price is far more likely to return and mitigate the flip zone. To use this model correctly, you need 3 timeframes. A higher timeframe to identify unmitigated areas of interest, such as supply or demand zones. A main timeframe to analyze overall conditions and spot flip patterns and flip zones. And an entry timeframe to zoom in and look for reversals and confirmation signals. This is where your entry will be placed. These are my recommended combinations that you can apply. You can use different timeframes if you prefer, but make sure to backtest them carefully before using them in live trading. Now, let us go step by step and see exactly how this plays out on the chart. In a bullish scenario, the first step is to analyze market structure on the higher time frame and identify the nearest unmitigated demand area that price is likely to reach. Once price taps into that higher time frame area of interest and shows rejection, the setup begins. Next, zoom into the main time frame and wait for price to retrace upward to test the most recent supply area on the main time frame. After a small reaction to the downside, price should immediately break above it. In other words, flip the latest supply. From there, trace back to the origin of the bullish expansion move, the reaction phase that initiated the break. That origin point becomes the flip zone. This flip tells us that the temporary bearish retracement is ending and that bullish momentum is returning. At this stage, we expect price to realign with the higher time frame trend. The next step is to highlight the flip zone on the main time frame, then wait for price to return to that zone. Once price taps back into the flip zone, zoom into a lower time frame and closely monitor for reversal signals, such as VSR patterns or a clear market structure shift. At this point, we have 2 different entry approaches for opening a long position. Each has its own strengths, the mitigation block and the breaker block. Now that we have covered all the rules, details, and everything you need to apply this strategy correctly, let us walk through a real chart example to reinforce what we've learned so far. Here, we have a 4-hour chart on the screen. As you can see, price is in a strong downtrend and the bears are clearly in control. The most recent bearish BOS is located right here, and at the origin of the move that created this BOS, we can see an unmitigated supply zone. So I am going to highlight this up-close candle as my supply area. This gives us a fresh, clean supply zone, and this is exactly where we want to focus because it is an ideal area to look for short opportunities if price pulls back into it. The next step is to switch into our main time frame, which in this case is the 15-minute chart, to get a clearer view of the price action and wait for price to tap into this 4-hour unmitigated supply. Now let us unfold the chart and see what happens next. On the 15-minute chart, you can see that after tapping into the higher time frame supply, price reversed and formed a clear VSR, a classic V-shaped recovery pattern. If you mark out the bullish BOS levels, you will notice that price created several consecutive demand zones on its way into the 4-hour supply area. Also, after tapping the higher time frame supply, price retraced downward and after a small reaction, flipped the most recent demand by breaking and closing below it. At this point, price is expected to realign with the higher time frame direction, which is bearish. So now we have a valid flip zone on the 15-minute chart represented by this up-close candle. With these confirmations in place, we can expect price to return to the flip zone before continuing its move toward the sell-side liquidity. Next, we wait for price to return to the flip zone, then zoom into our entry time frame, the 1-minute chart, so we can identify a precise entry for a short position. On the 1-minute chart, you can see the price pushed upward and, after tapping the flip zone, reversed sharply and formed both a market structure shift and a VSR. At the same time, it created a breaker block represented by these 3 down-close candles. Notice the sequence here. Price first formed a swing high, then a swing low, followed by a higher high. But immediately after, it reversed direction and closed below those down-close candles. This confirms the breaker block and gives us another strong confluence for a short entry. With these confirmations in place, we can expect price to pull back to the breaker block before continuing downward toward sell-side liquidity. Next, I'm placing my entry at the lowest point of the breaker block with my stop loss just a couple of pips above the higher high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now let us see if the trade plays out successfully. As you can see, price pushed higher, activated the sell limit order, then reversed and dropped until it eventually reached the take profit. This completes the full sequence of confirmations and shows how the flip zone, the breaker block, and the lower time frame shift work together to create a clean, high probability setup. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader Community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.